Good afternoon, everyone, or actually good morning. Hope you all had a good weekend. I'm sure by now you've all seen the scores for the quiz. Just keep in mind that those whatever you received on that quiz will be the score that you receive. Oh, you haven't seen your scores yet? All right. You know what? After class, I will open it up. You were supposed to be able to see it after the session. So in between, right after our session, I will make those grades available. Sorry, I thought you were able to see it for some reason. Keep in mind that that's the grade that is going to be added to your midterm grade. Again, we're going to have our midterm on 10/23. Okay, so next Tuesday. We'll be having the quiz, and then I'm sorry, you'll be having the midterm. Okay, now I've had a little bit, yeah, that is 10/13, right? That's Tuesday? Yes. So now I've had a little, after discussions with other professors in our department and some concerns that actually individuals in this class and my other classes had, I have decided that we're going to be having all of our exams on McGraw-Hill. Okay, so no more Blackboard. All right, we're not going to have the midterms on Blackboard. They are going to be on McGraw-Hill. All right, just like the quiz was. So for you, it should be pretty invisible. You're not going to notice any difference. There were some privacy concerns that people had mentioned with the proctoring software. So after a lot of discussions within the department, I've decided to not proctor the exam, but I'm going to give algorithmic questions that you're going to have to answer. Okay, so it's going to be, and different versions, etc. So that is how we're going to move forward. I'll make it official in an announcement so you remember it. All right, so we're going to move forward. We'll have our first midterm next Tuesday. This coming Thursday, then, I will do a reviewing class. Okay, just to give you a heads up on the areas that you can expect, all right, to appear on the midterm exam. Again, remember, it is going to cover the chapters that we've gone over so far, which is chapters 12, 7, 10, and 9, which we're going to complete today. All right, so we're moving forward with the semester. It's going to be, yes, it is going to be multiple choice, but it's multiple choice algorithmic. So that means that everybody's going to get a little bit of a different version. So for the midterm, of course, where would I start reviewing? Once I make the quiz slides available, you'll look at the quiz. Again, obviously, you're going to look at your notes, okay, that you've been taking over the course of the semester. And I hope a lot of you took my suggestion and you wrote the note cards going over all of the important parts. Our quiz is going to be on 10/13, okay? So let me just get it here. I'm sorry, I keep saying quiz. Our midterm, our first midterm is going to be on 10/13, okay, which is next Tuesday. It will be during class time. Okay, it is going to be for an hour and a half, right? And it's going to cover the chapters that we've covered, that we've gone over so far, which includes chapters 12, 7, 10, and 9. Okay, but it is going to be, there'll be a few theory questions. Good question, Denisa. There'll be a couple of theory questions, but for the most part, there's going to be a lot of calculation questions. Okay, so make sure you have your calculator with you, obviously. Okay, yes, the first 4 chapters were Gavril that we went over since the beginning. So yes, that's going to be the chapters. Remember, though, that some of those chapters are partial chapters. All right, so just go over the chapter, just go over the particular segments that we covered in class and that appear on the syllabus. Okay, all right, so that's how we're going to move forward from there. Okay, so this chapter was chapter 9. Okay, and again, use your quiz as part of your review also. I'll make that visible right after our class, okay, on Blackboard. All right, so We were going over intangible assets last time. And again, intangible assets basically have no physical characteristics. Okay, but typically what they encompass is some type of legally protected right that the corporation has. Okay, some of the common examples are patents, trademarks, goodwill, copyrights, franchises. Okay, so that's what we're going to go over examples of all of those particular types of patents. And again, remember that intangible assets appear in a separate section on the balance sheet. Okay, under the assets, they're really the last section after plant, property, and equipment. Okay, and again, those are physical assets. After plant, property, and equipment, then you're going to have the intangible assets section. Okay, now the trickiest intangible asset that we had talked about was goodwill. Okay, goodwill again is only gets recorded when one corporation buys out the assets of another corporation. Okay, again and again, when the other business is bought out, the purchaser buys in excess, okay, or the purchaser pays, okay, in excess. So goodwill is the excess of the fair market value of the net assets. Okay, so it's the excess paid, okay, over the fair market value of the net assets of the acquired company. Okay, so again, the example that I went over in class is that we looked, and again, it's the fair market value of the net assets. So you would take the fair market value of the assets minus the fair market value of the liabilities that are outstanding. Okay, and if there's any difference between those two amounts, that basically represents the goodwill. Okay, that will be recorded on the purchaser's balance sheet. All right, remember that goodwill cannot be internally generated. Okay, it can only be recorded when one company buys out another company. And typically, why would you be willing, if you're the purchaser, why would you be willing to pay in excess of the value of the fair market value of the net assets? Typically because the company that you're buying, okay, has a favorable reputation, a positive market share, a positive advertising image. Okay, basically, you know, if for Apple, Amazon, typically the employees that work there, they've been trained so that they have the employees have a high reputation for quality and loyalty, or they have some type of manufacturing or operating efficiency. In those particular circumstances, then the purchaser would be willing to pay more for the acquired company. Okay, and remember in the calculation we did, we compared those two restaurants. Okay, when you're calculating goodwill, what you're going to look at is again the fair market value of the net assets. Okay, but the other information that has to be provided to you, okay, is basically what the rate of return is. In the particular industry you are looking to buy a business in. Okay, you would have to be told, okay, you couldn't figure it out anyway, you would have to be told what the normal rate of return is. Okay, and again, where would a purchaser get that information? From trade journals, from industry guides, things of that nature. Okay, again, if you're going to buy a business, you're going to have to do your homework, right? To figure out, okay, what's this business? Is this a business I want to basically become involved in? What are the normal expected returns in this business? And then again, for the specific company you're looking to buy out, or the purchaser is looking to buy out, you would look at, you would also look at the average earnings for the past several years. Okay, and then you're going to compare, okay, what are the industry, okay, what are the typical industry earnings? You're going to compare it to the average earnings for this particular company. Okay, only if the average earnings are higher than the industry standard. Okay? If the earnings are higher than the industry standard, that's when you would consider basically paying more. The purchaser would be willing to pay more for this particular company. Okay, and I know now in your learning of accounting over the past several semesters, basically you know that in the United States we have US GAAP, right? The generally accepted accounting principles, which is basically administered by FASB. Okay, you also know that there's something called the IASB, which is the International Accounting Standards Board. Okay, and there's I think about 100 member nations, right, that are part of the IASB, which is the International Standards Board. And you know, in a lot of instances, FASB and the IASB do not correlate. There are differences in the standards. Okay, but this is one particular instance when you're dealing with goodwill. Okay, the U.S. said typically what happens with intangible assets is typically it's going an intangible asset is going to be amortized over its useful life. For all the other intangibles we're talking about, it's going to be amortized over its useful life. Okay, goodwill is different. Okay, FASB decided that the way that goodwill has to be treated, okay, so goodwill is the exception. Goodwill has to be tested on an annual basis, okay, to see if it still exists. Okay, so so it's going to be a little different. So goodwill has to be tested, and if it has been impaired, okay, so here when we're looking at goodwill, the test at year end is for the impairment of goodwill. All right, and how do you think you'd be able to figure out, okay, you purchased this company and you're trying to figure out, has goodwill been impaired? All right, what would be a test that you would do at year end? Where would you look, okay, on the balance, on your own balance sheet to see whether goodwill has been impaired? Any ideas? How could a purchaser perform a test? What would they look at? Okay, a little bit furthermore, Joshua, you're almost there. What's at the bottom of that financial statement? Not revenues, but net income, Lysander. Very good, Oscar. Excellent. Net income. If you see that the net income, okay, from the segment or from the corporation you have purchased, basically it's been deteriorating, okay, which is not unusual. Okay, if the net income has been deteriorating or is not at the level that it was or you expected when you purchased this company, that would be considered an impairment of goodwill. So that would be a test you would have to do. Okay, now previously, okay, prior to 2004, the IASB just was amortizing goodwill the same way they did all other intangible assets. They just said, okay, I'm just going to look to see, I'm going to just divide the cost of my goodwill account. I'm just going to divide it by the years of useful life. Okay, but in 2004, the IASB agreed with FASB's treatment. So now the IASB treats goodwill the same way that FASB does, meaning that they test it at year end for impairment. Okay, and again, you get to see in the future how these two organizations are trying to really meld. Okay, so that if you look at the audited financial statements of a company doing business, let's say in Italy, and if you look at one that's doing business in South America, okay, those financial statements, all of the standards would be the same. Okay, that's the ultimate goal. And in this particular instance, when they were dealing with goodwill, the IASB decided to adjust their standards because they believe that a test of the impairment of goodwill is more accurate. Okay, so for goodwill alone at year end, once goodwill has been tested, okay, and again we would look to see the net income from that particular. You remember the earnings, because that's how we determine goodwill, really based on the excess earnings. If that company no longer had excess earnings, that would be an instance where basically goodwill account would have to be adjusted. And what is that journal entry? Again, an adjusting journal entry at year end. You would just debit the impairment of goodwill. Okay, and this is, and it's actually the loss due to the impairment of goodwill. It's a loss. So where would it appear? It would appear on the income statement. So you would have here the impairment of goodwill, the loss due to the impairment, and then you would just credit, remember, for intangible assets, you were just going to credit the intangible asset account directly. Okay, so that would be the journal entry at year end for whatever the amount is that the corporation felt the goodwill account had deteriorated by. Okay, all right. So now we've dealt with goodwill. Goodwill is it is an intangible asset, but it's treated a little differently. Okay, remember that goodwill can never be internally generated. It has to only be recorded when another company is bought. Okay. All right, so now we're going to deal with all the other intangible assets. So I'm going to go back a little bit here just as to how it's dealt with. Before I go there, though, I remember we always have to review what our investment. Okay, you know, the stock market has been very tumultuous over the last few weeks. A lot of political things going on. Again, the coronavirus, the earnings of Compass, a lot of this has been affecting the stock market. So last time we met, which was last Thursday, our one share of Apple stock was trading at $116.87. And as of a few moments ago, it was trading at $215.10. Again, there had been a little bit of volatility, but now that is the amount it's selling at. Again, remember that basically a lot of industries in the United States are hoping that another stimulus package is going to be issued by the federal government. We'll look to see what happens there. Okay, but all right, so we're going to move forward from there. And again, that reflects the stock price and the stock split, okay, for Apple. Remember stock splits, stock dividends, all that fun stuff. Okay, chapter 12. Okay, again, make sure you go over that. Guaranteed at this point that there are going to be questions on that. Okay, so now when we're dealing with all the other intangible assets that we're talking about, okay, remember that intangible assets are always going to be recorded at their cost. Okay, now occasionally what happens with intangible assets? Typically, if you have some type of intangible asset which has been internally generated, or internally developed, I'll use that. If there is an intangible asset which has been internally developed, okay, that means the employees of the corporation have basically been working on this particular marketing project or on this particular product design. Okay, so if an intangible asset is internally generated or internally developed, typically what happens is that all the related costs are expensed in the year that they are incurred. In the year that they are incurred. Okay, and again, then you would just be charged against the income statement in that for that particular year. It's typically only when an intangible asset is purchased from an outside source and that means that the cost most likely is going to be substantial. So when an intangible asset is purchased from an outside source, okay, then the cost of that asset will be capitalized. Okay, meaning that they've paid a substantial value for that particular intangible, so that's why it's going to appear as an intangible asset on the balance sheet. Okay, so there's a little differentiation there, and I'll go over examples of this when we go over each of the intangible assets. Okay, now, if an intangible asset's cost is significant and it is capitalized, okay, so here, the intangible assets cost is significant. Okay. What has to happen then at year end, just like any other tangible asset that they have, basically that intangible asset is going to have to, the cost of that asset is going to be amortized. Okay, so you don't depreciate an intangible asset, you are going to amortize an intangible asset. Okay, and again, amortization basically is the, again, same definition for depreciation, the systematic write-off to expense of the cost of that intangible asset over its useful life. Okay, and remember, you would always have to be given this information. We're not following tax law or anything, so you would have to be told what the useful life was. Okay, again, it's very similar to depreciation. The only difference is, okay, when you're recording amortization expense, the journal entry is always going to be, you are going to debit the amortization expense for that particular intangible asset. Okay, you're going to debit the amortization expense for that particular intangible, and then you're going to credit the actual intangible asset account. Okay, so there's just the difference is there's no accumulated amortization account. Okay, you adjust the balance immediately. Okay, so just a little different. All right, so here again, the usual accounting entry, a debit to amortization expense and a credit to the intangible asset account. And remember that amortization expense is a normal expense, so it will appear on the income statement of that corporation. Okay, good. Okay, and again, a lot of times it's difficult to try to estimate, okay, how long is this trademark going to basically bring revenues, okay, to this corporation? How long is this patent actually going to be relevant? That is, that no competitors have come up with a superior product. Again, typically it's going to be an estimate, okay, and that estimate may be revised over the asset's useful life. Okay, what we're always going to do, okay, hint, 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 there's no accelerated depreciation method for intangible assets. You're always just going to utilize the straight line method. Okay, the straight line method is typically the method that is used. So you're just going to divide, what does it mean? You're just going to divide that intangible by the expected years of life, which you'd have to be told. Okay. All right, so goodwill we went over already. That's the tricky one. Remember, only when you purchase another corporation. Can we see an example of straight line with nothing? We're going to go over that in a minute. Okay, when we get to the actual intangibles, we'll get over that in a minute, Josh. Okay. Okay, so the first intangible asset, well, the second intangible asset that we're going to talk about are patents. Okay, now you know, if you think of patents, what typically comes to mind? Which industries? Typically, it's going to be the pharmaceutical industry, right? We know that the pharmaceutical industry has basically has a lot of patents to protect their products. Okay, and also technology. Right, we know that technology and pharmaceutical companies typically have a lot of patents. And what exactly is a patent? Okay, remember, a patent must be filed with the U.S. government for a U.S. Corporation. Okay, so a patent is an exclusive right, okay, that is given by the federal government for the manufacture, use, and sale of a particular product. Okay, again, it gives you exclusivity. Okay, a patent basically gives the holder exclusivity to that particular product. Exclusivity. Okay, over the particular rights to that particular product. Okay, and again, why does the federal government offer this exclusivity or protection, really? Because they're trying to encourage the invention of new products. Okay, if I'm a pharmaceutical company, and a great example, of course, is the vaccine for the coronavirus. If I'm putting billions of dollars into research, okay, for a particular vaccine, okay, if I'm putting billions of dollars of cash into it, but once I come up with the formula for that vaccine, basically it's going to be available to, by all the other pharmaceutical industries. They can basically piggyback and copy whatever my particular formula is for coming up with this particular vaccine. Basically, why would I get involved? Why would I do the research and development for this particular product? Okay, what happens when you register, okay, with the federal government and they approve your application? Okay, basically they protect your rights, okay, over the manufacture, use of that product or process, okay, typically for a period of a maximum of 20 years. Okay, so you as the corporation that files for that patent, you have exclusive rights, okay, for 20 years. Okay, however, if the useful life of that patent is less than 20 years, okay, it's always going to be the shorter. Okay, the period of amortization is always going to be the shorter of the useful life of the intangible asset, or 20 years. Okay, all right. So after this period of time, either the useful life or 20 years, what happens if you're a pharmaceutical company? Okay, basically it becomes a free-for-all. And actually, if we look at in particular, if we look at the pharmaceutical industries, there's a whole sub-market, right? Like once a patent has expired on, let's say, a particular drug, what happens now? That drug is going to be manufactured, and it's a whole generic industry that basically has developed for those companies that are going to sell the identical product once a patent has expired by the holder. Okay, so again, patents are significant. Okay, again, they give you an exclusive right to the patent holder. What can you do if I'm, what's a big pharmaceutical company? Pfizer. Okay, so if Pfizer has a patent and they find out that another company is basically selling the exact same product that they have a patent for, okay, what can Pfizer do? They can basically sue that company for a patent infringement and for damages. Okay, so again, Pfizer would have a legally protected right. Okay, what else would Pfizer do? Pfizer would also show this intangible asset, okay, if it has a substantial cost to them. Okay, they would show that intangible asset on their balance sheet under patents, okay, under that particular account. Okay. Again, though, okay, just like with all the other intangible assets except for goodwill, if basically this product, okay, has been developed internally, okay, and all the research and development expenses have basically been charged against income over, the last 10 years when they've been researching this particular product. All right, when they're finally granted a patent, if it's been internally generated, typically the cost is going to be minimal. Okay, so you're not going to see a patent per se appearing on the balance sheet. Okay, but you would find that they have a patent then in the notes to the financial statements. You would find the details behind that particular patent that has been developed internally. Okay, if, however, Pfizer purchased, this patent from another company, then that would have a significant cost to them. All right, so let's say Pfizer, let's give an example. Joshua, you wanted an example? All right, let me just clear okay. So let's say that Pfizer purchased the patent for $2 million. Okay, so when Pfizer purchased the patent from an outside party, they purchased it for $2 million. Okay, that's a significant cost. We know that that cost is going to have to be capitalized on the balance sheet. Okay, and let's just say they have a lot of cash in available for sale and marketable securities, right? This is something that we learned in a previous chapter. All right, so here at the day of purchase, they're going to debit the patent account, credit the cash account. All right, and now let's assume that it has a 20-year life. Okay, because that's the maximum period of time that an intangible asset can be amortized over. Here, so we're going to assume a 20-year life. All right, so what is the journal entry going to be here? All right, we are going to debit amortization expense. And then here, remember, you're always going to indicate which intangible this is with amortization expense patent. Okay, and you're going to divide the $2 million by the 20-year life. All right, so what is the amount that is going to be amortized every year? $100,000. That will be debited to amortization expense. Okay, and then what is going to be credited? Okay, remember when you're dealing with an intangible asset, that intangible asset is going to be credited directly. $2 million, you take the cost of the asset, which is the $2 million, and divide by the maximum of the 20-year life. Okay, and okay. Yes. Oh, I'm sorry. Yes, Lysander.
If, let's say, in a problem, it's guaranteed that they have less than 20 years, do we divide it by those years as well?
Very good. Excellent question, Lysander. I hope everybody heard that. What if I told you that, okay, I know a patent has a maximum of a 20-year life. Okay, if, however, you're told that the useful life is only going to be 10 years, okay, in that instance, since the useful life is only 10 years, you would divide by the useful life. If it's less, okay, you would never use anything in excess of the 20-year life. Okay, it's always the shorter between. Very good, Lysander, excellent question. Okay. All right, and this is going to be the same for every single intangible except for goodwill, which we already discussed, which is tested. Okay. All right, so that's patents. All right, oh, and here again, this would be another example. Okay, so here, okay, and Lysander, this answers your question. Assume that the patent is purchased from the inventor, Okay, so this company is buying it from an outside party, so the cost is going to be significant. Again, it's not internally generated. Okay, and it cost $100,000. Okay, after 5 years, okay, so 5 years have expired in this patent's life. Okay, so again, if this, in the best case scenario, this corporation that was buying this patent would be dividing the cost of that patent, would be amortizing the cost of that patent over a maximum of 15 years. Right, because it has already run 4 or 5 years of its total protected. Okay, but okay, if the useful life is only 8 years, okay, and again, that you would have to be given. That was basically somebody, an expert in that field. They know another type of product or competitor is developing a product, which is going to be released in 8 years, which is going to be superior to the one you have. Okay, here in this instance, since the useful life is only 8 years, okay, you would have to amortize it based on the shorter period. Okay, so here you take $100,000 and you're going to divide it by the 8-year life, and here this would then be the appropriate journal entry. Again, debit amortization expense patents and credit the intangible asset account directly, reducing it. Which for 12,500. Okay. Again, but if you're told that a competitor is not coming out with a product until 30 years in the future, that is irrelevant. It must be a maximum of 20 years. Okay. And here, it's always the intangible I send you directly for intangibles.
So it'll be intangible asset?
Always. Always. Yeah, there's no accumulated. Okay. Typically, you know what? Since it has that protective, no, because you don't want to make it too restrictive, Gerson. So typically, unless you, new and improved, unless you can substantially change it, you're not going to be able to renew it. That's the rule. You get 20 years to recoup the amount you invested, and then that's it. It becomes public knowledge at that point. Okay. But again, now we're talking about, again, we're dealing with, you're welcome, within a global environment. Okay, what happens is a lot of times in the United States, a patent is issued over a particular item, okay, or a particular process. What happens though, if there's an infringement of that patent in another country, okay, let's say in China, in Russia, in governments that are not really as open, okay, as the United States is in terms of trade or in terms of business, what can happen? It's very hard to basically sue for damages in another country. Okay, you're right, and that's been a big problem, you know, with Trump and with China, and with trying to negotiate better deals, basically due to the fact that patents are not really respected in China. Okay, they will copy and not respect the fact that it's protected in the United States. Okay, so again, internationally, this does bring up a problem. Okay, with international business. Okay, so we'll look to see what happens with that in the future. Okay, so let's move on. The next type of intangible asset is trademarks or brand names. Okay, and what does that mean? You know, basically, if you go to any country in the world, if you know that the red and the white, okay, you know that that particular type or font, you know, it means it's Coca-Cola. If you see that yellow M, okay, you know it's going to be a McDonald's. You feel safe that if you go to any businesses, you recognize the trademark or the brand name, and then you know that basically you're familiar with the products, okay? Company, or, you know, for Nike, they have the swoosh. For Mercedes, they have the peace sign, right? Well, it's been ingrained in your brain, and you probably don't even realize a lot of them. Okay, you've made that association. So, good example, of course, is Coca-Cola. They have that distinctive, basically typeface, the red and the white. It's known throughout the world. Okay, you know, if you order a Coke, you know what you're going to get. Okay, again, a trademark is a name, a symbol, or design. Okay, that is exclusive to that company. Okay, so again, the corporation has to file for a trademark. Okay, again, with the US government, if they're doing business in the United States, okay, and the government then is going to give that company an exclusive right to use that trademark, brand name, or commercial symbol. Okay, and again, it must be registered within with the federal government. Okay, and then Christian, can you extend the life if it is less than 20 years? Not usually. Don't overthink it, okay? Good question, but for our purposes, it's either going to be the lesser of its useful life, okay, of an intangible, or for a patent, or 20 years. Okay, but typically, if you find, okay, so maybe if you find, Christian, it's never going to happen in our examples. So if you find actually that the useful life is going to be greater because of the fact your competitor didn't come up with a competing product, and you're still under the 20 years, yes, then you would be able to charge to spread the cost of that asset over a greater period if its useful life you feel was extended, but never, again, never above the 20 years. Yes. Okay, but don't think of that on an exam. I'm never going to make it that tricky. Okay, but good question. You're welcome. Okay, so trademarks, again, legally protected right to use a name, symbol, or trademark. Okay, now what typically happens with trademarks and brand names? Okay, okay, again, just like with all other intangibles, if that trademark or brand name has been internally developed, okay, that it's been developed by their marketing department, okay, either by their marketing department or their advertising department. If you see that any of these patents are developed internally, okay, basically what happens is that all the related costs, are expensed in that year, Okay, all right. It's only when you're purchasing a trademark or a brand name from another company, let's say from a big advertising company or a marketing company, they did all the focus tests, all of the brand name development, etc. When you're buying it from an outside source, okay, then it is going to be significant. They're going to make you pay for all of that because they're doing all of behind it. So if the cost is significant, again, if it's bought from an outside party, from an outside source, only in that instance would the cost be capitalized. Again, if that cost is capitalized, it would be capitalized and amortized over its useful life. Okay. Okay, so if a trademark or brand name, as it says here in this slide, if a trademark or brand name is purchased, the cost may be substantial. Okay, and then it would be capitalized and amortized. Okay, and that would be the same really for any intangible asset. Good. Okay, the next legally protected right, and again, you would purchase this, okay, is something called a franchise. Now, you're all familiar with franchises, right? McDonald's, Burger King, is a million of them, okay? Basically, a franchise is a right that is granted by a company, okay, or a governmental unit, okay, to do business in a certain geographical area. So what does that mean? That means basically if I buy a McDonald's franchise, again, I'm paying millions of dollars for that. McDonald's has basically developed a whole line of business. Okay, and what they're basically doing is they're giving me exclusivity in a certain geographical area. Okay, once I purchase a franchise from McDonald's, I know that they're not going to sell another franchise across the street from me. Okay, within a certain area, geographical area, within a certain area, I know that they're not going to give a competing business. They're not going to sell a similar franchise in that area. Okay, Why would I be willing to pay millions of dollars for it though? Because they have established the brand identity, they have established all the marketing, the product line, etc. Okay, so I'm buying one of their business units, okay, and basically it's for very specific as to the geographical area, okay, and why? Because it has a proven business model. That's why basically I would be interested in a McDonald's franchise. It has a proven business model. I know typically what the rate of return is, okay, if I purchase that type of franchise. I don't want to do all of the groundwork. Okay, so I know that they've done all that work ahead of time. Again, you go to any country and you see that bright yellow M, you know what it represents. You're going to go running there just to have some food that's familiar with you. And again, that's what a franchise is. Okay, the cost of a particular franchise can vary greatly. Again, it's always basically whatever the parent company feels that they can charge their franchisee. Absolutely, Stellan. It's $1 million, more than $1 million, I would assume. Yep. Okay. And what I always found was interesting, like, McDonald's, you have to go a couple of blocks usually, even in a big city, before you find a McDonald's. Like, there will be one here. Again, you'll find another one in a different area. But what a store can you basically go in the city? If you go every other block, you're going to find this particular business. Okay, what business is so large that if you go usually every other block, there's going to be this type of business that you're going to find. Absolutely, Casey. Starbucks. Very good. So, but why does Starbucks? It seems like they don't really have, it seems like they're competing with each other, because you can find one really on every other street, almost in every other country. Okay, and the reason is that Starbucks isn't franchised. Okay, they own all of their stores. Okay, so that's why it's a little different. They're not competing against each other. They figure, either you're going to buy the Starbucks here, or you're going to wait and you're going to get it in 2 blocks from there. Okay, so that's really the difference. Okay, when you have a protected franchise, there's not another business like this. Okay, another McDonald's, which is going to open up within that protected area. Okay. So what period of time is a franchise going to be amortized over? Okay, again, only if the cost is significant. Okay, it's typically going to be amortized over its legal life. Okay, that's the rule of thumb. The cost of a franchise is going to be amortized over the lesser, let me just expand that a little bit, over the lesser of its legal life or its useful life. Okay, and again, if a franchise fee is small, okay, again, then like if you're buying a small burrito restaurant and the franchise fee is small, then you could just expense it in that particular year. Here we're talking about, for our purposes, let's just say we're dealing with major franchises. Okay, so if the cost is significant, again, it would be amortized over the lesser of its legal life or its useful life. And we've seen that journal entry, again, debit to amortization expense and a credit to the franchise. Between franchises and chain stores, typically what happens is so Joshua, a franchise is independent. Okay, so if I buy a McDonald's franchise, I'm the owner of that franchise. I still have to abide by all those rules, that they basically bestow on me, but I basically am responsible for the results of operations of that company. Okay, but when you have a chain stores are usually not independent. They are going to be all owned fully by like a Starbucks, they're going to be owned fully by the parent company. There's not independent owners. Okay. You're welcome. All right, so that's franchises, that next intangible asset. All right, very important intangible. The next one that we're going to talk about is copyrights. Okay, now a copyright, again, is a right, an exclusive right. You have to file for this, okay, with the federal government. Okay, now the rule is if I'm the artist that and again, where do you usually see copyrights? Which fields do you typically see copyrights? Typically in the publishing field, okay, or the music industry. Yes, very good, Gerson. Publishing and music industries is when you would see a lot of copyrights. Okay, you have some type of artistic material or literary material, and you want to protect the right to that. Okay, so what the federal government does is that if you're the creator, okay, if you're the creator, if you get a copyright, okay, that copyright is registered, and it's going to give you exclusivity over that product for the life of the creator plus 7 years. Okay, so if I write a book, okay, and basically I file for a copyright, okay, protection of that book for my life, and then the life of, usually it's my next of kin. That's what they're looking to do here, to protect basically the rights to that material for 2 generations. Okay, that's the period of time that is going to be covered if I don't sell it or they don't sell it, my next of kin. Okay, however, if that creator decides to sell the copyright to an outside party, okay, again, when you're buying it from an outside, when an outside party is buying it from the creator, that's when, like, if you might buy the Michael Jackson, you know, all of his music, or John Lennon, or any artist, okay, if you buy the copyright over their material and they're a major star, again, that's going to be significant. Okay, not when it's internally developed, when it's sold to an outside party. Okay, so when the copyright is sold to an outside party, from the creator, okay, that's when the cost is substantial. Okay, the cost is going to be substantial, and then it is going to be amortized over its useful life. Okay, and that's the rule really for copyrights. Okay, again, when a copyright is purchased from an existing owner. Okay, so if I wrote a book, again, I'm not going to, is Happy Birthday, is it still copyright? Is it? I don't know. I know they fought that in court, that somebody said, again, not that original song, if you think about the words, but I think Happy Birthday, yes, is copyrighted. And a lot of, like, jingles for, I think it's a lot of jingles, like, for commercials and things like that, they've been copyrighted as well. Okay, but sometimes, again, what happens if you find somebody violates that copyright? You have to take them to court. Okay, so it's always the time and the energy and everything, and you have to be able to establish yourself as the holder, right, of that copyright. I heard there was some stuff, some legal situations with Happy Birthday song. So yeah, I remember that also. It's pretty good, but again, try to defend it, right? Try to go to every birthday party that you see and try to get them to pay restitution. Okay, that's funny, Christian. Okay, so again, only when it's purchased, that's when it's going to be. So Denise, so basically, if I sell something I've copyrighted, it's an expense. It would be an expense to you, but if it's no, but if I not bought back, let's say I write a book. I write a book about, let's say, the coronavirus epidemic and how it affected civilization. All right, and I file for copyright with the federal government. Okay, I might have spent 5-10 years, okay, basically writing that book. All right, but I really haven't been able to charge anything to expense over its useful life. But if 10 years from now I get a patent, I get a copyright over that, nobody can copy any of that material from my book. Okay, and again, all I basically did, I just basically charged it, you know, any expenses that I had, I charged it against my income. Okay, if, however, though, I sell the copyright, okay, once I get the copyright for my book, if I sell it to a major publishing house, okay, that's when the cost to the publishing house is going to be significant, and then it would appear as an intangible asset, as a copyright on the books and records of that particular publishing house. Okay. If I didn't sell it though, okay, so Denise, let's say I didn't sell the copyright. I held the rights onto my books and I sold it. Okay, how long would I have that copyright as an individual? Basically, I would have that copyright. It would be in effect over my lifetime. Okay, plus the 70 years. Okay, so if I give the rights to that to one of my heirs, let's say, okay, they would have exclusivity over the proceeds, okay, of that particular book over their lifetime as well. If it's held by the artist, it's the life of the artist plus 70 years, okay. If it's sold though to an outside party, okay, typically the cost is significant, okay. Only at that time then would that copyright appear as an intangible asset under the assets of that corporation. Okay, and it would be capitalized in that instance and amortized over its useful life. Okay. All right, very good. Oh, you're welcome. Okay, is that clear to everybody? And all these intangible assets are the same. If it's typically internally generated, the cost is just charged to expense in the time period that it's being developed. And then and it wouldn't appear again. It would appear in the notes to the financial statements if it's a publicly traded company, okay, because you do have a protected right. Okay. So I'll use an example. My brother worked for a software engineering company. This is a true example. So he worked for a software engineering company. And he developed basically a prototype for like some type of like cell phone battery, let's say. Okay. Since he was an employee of that company, his salary was just being charged to expense over all of the years. Okay. Once that final product was developed, okay, and they got, let's say, the patent for that particular company, it's an asset. It's an intangible asset of the corporation. But since it was internally developed, basically the cost for developing that product was charged against income, right, over the development life. All right, so it wouldn't appear necessarily on the balance sheet as an intangible, but you would see it being reported in the notes to the financial statements. Okay, same thing with all these other intangibles. If developed internally, the cost is really insignificant. It's only when you sell it to an outside party or you buy it from an outside party, that's when the cost is significant, and then it has to be amortized. Okay, is that good? Okay. All right, so that's what copyrights basically. Okay, now this one is the tricky one. This throws everything else. Now, let's talk about research and development costs. Now, you know, research and development costs, again, typically in the pharmaceutical and the technology industries. We know that research and development is substantial. It's a substantial amount of the expenses that they incur on an annual basis, the pharmaceutical and the tech industries. Okay, we know billions and billions of dollars are being paid or basically incurred in research and development costs. The problem is, okay, companies don't know. A pharmaceutical company doesn't know. Okay, they're doing all this research on the coronavirus. They don't know if they're going to be the company that comes up basically with the vaccine. But they're doing all of this research and development, billions of dollars. Okay, since they don't know if and when they're going to come up with a final product, okay, and this is very important. Since a corporation doesn't know if they're going to come up with a final product after doing all of the tens of billions of dollars in research, basically the rule is whenever a corporation has research and development costs, okay, research and development costs are always just going to be expensed immediately. Okay, research and development costs are never capitalized. Okay, because the company doesn't know if they're going to come up with a final product ultimately. Okay, they may come up with another product they hadn't even anticipated, right? That can happen as well. Okay, so here the rule of thumb is regardless of the amount of that was invested, research and development is just debited to an expense in the year that it is incurred. Okay, so companies again spend billions of dollars each year on the research and development. That annual research and development can be in excess of $1 billion. It doesn't matter, it still must appear on the income statement and be expensed in the year it's incurred. Okay, but what's the payback? Why would I bother doing all this research and development? Okay, all of these years, okay, and just charge it to an expense. When do you finally get your payback if you come up with that product? Well, you get, okay, so you get, all right, so Gerson, you're being a real accountant. You're saying, okay, so my taxable income is going to be lower, okay. But what else happens when I finally come up with that end product? What am I going to file for? Patent, very good. Exactly, Casey. When I finally come up with that product, okay, that's when, since I've spent all of this money, okay, I paid all of these expenses over the development life, which were charged against income. When I finally come up with that final product, I am then going to be able to have a protected right. I'm going to be able to basically file for a patent. So I have some exclusivity over my product development and distribution. That's exactly right. Okay, so that's the way that it works. Okay, product doesn't matter the amount of research and development, it's always expensed in the year incurred. It's only really once you come up, because then you have that final product, okay, and then you can anticipate, okay, what are the revenues from this product going to be? Okay, until you come up with that final product, it's just an expense. Okay. And again, here at FASB requires that as a general rule, all research and development is charged to expense when incurred. All right. All right, so we don't have to worry about that. Okay, now, okay, the last thing that we're going to look at. So now we're leaving intangible assets. Okay, we've left intangible assets, but now we're going to look at another section of plant, property, and equipment. Okay, we are now looking under the heading of plant, property, and equipment again. Okay, now what can happen, okay, is a particular company is involved in with natural resources. So typically when we're talking about natural resources, what fields are we talking about? We're talking about timber. We're talking about gold. We're talking about precious metals. Okay. All right. Now we're talking about companies here that basically this timber, the gold or precious metals, they are involved in these particular industries. Okay. And these particular elements are basically what their inventory is made out of. Okay. So these companies are basically in the business of selling timber, gold, or precious metals. Okay. The issue with these particular industries is that their inventory isn't just existing in some storage room or in some warehouse. Okay, what has to happen in these particular industries is that these natural resources have to be physically removed from their natural environment. Okay, so what's happening is I'm buying a mine, I'm buying an oil field, I'm buying a forest or a plot of land that has a lot of trees. Okay, and again here, mining properties, oil, timber, things of this nature. Okay, so these particular items, okay, these items are going to be, I'm going to buy a mine or a forest, a tract of land. Okay, and all these particular items, these are going to be the long-term assets. Okay, all of these particular items are going to appear under the long-term assets on the balance sheet. Why? I'm buying these assets because basically they have a long-term revenue stream to the corporation. Okay. The issue is, though, what am I going to have to do? All right. I'm buying a mining property. I'm buying an oil field. I'm buying a forest. Okay. But what I'm going to have to do is somehow extract or physically remove some asset from these properties, okay, in order to make them part of my inventory. Okay. So I'm buying these particular properties. They're going to appear as a long-term asset, okay, under plant property and equipment, okay? And then basically as I extract, okay, as I extract the natural resource, I'm going to extract the natural resource from these properties. And then I'm going to sell them. Extract the natural resource from these properties and sell them. Okay, this is what makes a natural resource very different. Okay, remember, we've left intangible assets. We know when we're talking about mining properties, forests, oil fields, we know those are tangible assets that appear on the balance sheet. Okay, but what's going to happen is we know that these properties are not going to last forever, right? They're going to last basically for a particular period of time, okay, because what am I going to do? I'm going to extract, okay? I'm going to extract a certain component out of that particular property, okay? Whether it's timber, whether it's a precious resource, okay? And then ultimately what's going to happen, I'm going to remove all of that natural resource from that property, okay? So let's see, how do we account for natural resources? All right, how do we account for these natural resources? All right, so theoretically, okay, now I want you to think of it. When I buy, if a corporation buys a coal mine, okay, really that coal mine is an underground inventory, right? But the coal mine as an asset, it's going to appear under my plant property and equipment at the cost that I purchased it at. Okay, so the mining property and any other natural resource is included under plant property and equipment, okay, at its original cost. All right, so it's always going to be here recorded at what the original cost of that property was, okay? But what happens is that once that particular resource is removed from the property, okay, now it becomes inventory, okay? So as resource is removed, it becomes inventory. Becomes inventory. Okay, so what's really happening here? I buy a mine. Okay, I buy a mine for $1 million. Okay, but I know what am I going to do with that mine? That mine is going to appear now at its cost on the balance sheet, which is $1 million. Okay, but I know that I bought that mine to extract the coal. Okay, so what happens is that as I extract whatever the natural resource is from that mine, okay, that's going to become part of my inventory account. Okay, so once the resource is removed, once that natural resource is removed, what happens is that a long-term asset, okay, is being converted to a current asset. Okay, I'm depleting. Now, when we talk about natural resources, we've talked about what so far. We know that for other plant, property, and equipment, we're going to depreciate it over its useful life. Okay, we know when we have intangible assets, we're going to amortize intangible assets over their useful life. When we talk about natural resources are always going to be depleted. Okay, depleted based on the amounts that are extracted. Okay, so here, a natural resource, when we talk about natural resources, we record them at cost, and then we're going to basically deplete, okay, that natural resource that is charged to expense, okay, as that natural resource is extracted, okay, from the property. As that resource is extracted, what's happening? We're reducing the amount of whatever that long-term asset is, okay, and then but we're taking whatever we extracted, and we're now turning it into inventory. Okay, so that's why natural resource accounting is a little tricky. Okay, everybody with me so far? Any questions? Okay, so let's go, it's best to use an example for this. Okay, so again, when we're dealing with natural resources, we deplete a natural resource. So we purchase a mine, okay, the corporation purchases a mine, but it's not depreciated, okay, it is going to be depleted, okay, as the natural resource is removed from the ground. Okay, does the land depreciate as the source is depleted? Excellent question, Kristen. Okay, for our purposes, no. Okay, so what's going to happen? Excellent question, Kristen. Since we know, and it's never going to be separated like this, but what's going to happen, we know if I buy a coal mine, okay, let's take an example. If I buy a coal mine, I know I'm going to mine all that coal from it. Okay, but that mine and all the land and all of its property is still going to exist, right, at the end of its useful life to my corporation. Okay, so what happens when you have natural resources? Typically, those natural resources are going to have a significant salvage value. Okay, so the land, as part of that as part of that natural resource, the land is going to be deducted. Okay, as part of the salvage value. Excellent question. Okay, and you'll see in a second how we do that. Okay. All right, you're welcome. So once all the coal and all the gold, they always use boring examples. They should use gold or whatever, some mineral. But once whatever we're mining for has been removed, then the mine is fully depleted, and it's going to be abandoned or sold for its residual value. So this is an instance where when you have this natural resource, typically they're going to have a very significant residual value. Okay, exactly for that, especially because even if I buy a forest and I'm going to remove all of the trees and all of the and make it into timber or lumber, exactly your point, Christian, that land still exists afterwards. That's going to have a value to somebody. Okay, but to me, it's really worthless. I'm going to then sell it for its residual value or salvage value, but it still does have, it could be a significant amount still. Okay. Okay, so it's excellent. It's the best way to do this is to show it as an example. Okay, so in this particular instance, Rainbow Mines pays $48 million to, and this is exactly how all of your questions would be set up. Okay, Rainbow Mines pays $48 million to acquire another mine, which is believed to have 5 million tons of coal. The residual value of the mine is estimated to be $48 million. I'm sorry, it's estimated to be $8 million. So here you can see in this example, the residual is significant. So the way you're always going to start a problem like this, you are going to take whatever the cost of that natural resource was. Here it was $48 million. Okay, and again, we're going to be dealing with big values. But from the residual value, you always have to subtract out, from the assets cost, you always have to subtract out what the residual value is. So here I would be subtracting out the $8 million. And this all has to be given to you. All right, all this information, you just have to know how to address it. Okay, so here the, it's supposed to be $48 million, sorry. This is actually 48. All right, so the $48 million minus the $8 million residual value, and then you are always going to divide then by the capacity. You would have to be told the capacity. So here the capacity is 5 million tons. So we had engineers go in, okay, and basically determine that they believe that 5 million tons of this natural resource exists in this particular mine. 5 MI T-O-N-S. All right, so that is going to be our equation. Okay, this is going to be our equation for the depletion rate. Okay, so this is the first thing that you have to determine when you have a natural resource problem. You have to determine what the rate of depletion is. All right, and here I see that Lysander, Kristen. Lysander, did you have a question? Oh no, here, Kristen, I'm sorry. So does the land depreciate? Oh no, that was previously. Lysander, did you have a question? I thought I saw something. No?
No.
Oh, okay, I don't know where that came from. Okay, so here that's a depletion rate, all right? So what do we determine? If we do this math, we see the depletion rate equals $8 per ton. All right, always set up the equation like this. So what does this mean? This means that anytime that anytime the resource, the natural resource, is extracted from the mine, okay, each ton that is extracted is going to be charged $8 per ton, okay, and that amount then is going to be converted into inventory. So here, what happens is that we're going to reclassify. Okay, through depreciation, we're going to reclassify a portion of that natural resources cost. We're going to reclassify it to inventory. Okay, so that's why we've never had this type of situation before. If we depreciated something, we know it just basically decreased the book value of that asset. All right, so let's look though what happens with a natural resource. So here, Rainbow Minerals buys Red Valley Mine. Okay, so what's going to appear? What's the journal entry when, and again, whenever you're in doubt in life, always go back to the journal entry, right? All right, so when this mine is purchased, they purchased it for $48 million. We know, and let's just say they had a lot of cash available. So let's just make it simple. Let's just credit cash here for the full $48 million. Okay, so this is the journal entry on the date of the purchase. Okay, then what happens now? All right, as now this corporation came up with this depletion rate, okay, of $8 per ton. All right, based on the cost minus the salvage value divided by the maximum capacity. All this information has to be given to you. Okay, then here you'll see, so all right, so here they just went through the math. You had the $40 million in the equation, and then you're going to divide it by the capacity, which is 5 million tons, and you came up with a rate per ton of $8. Okay, so, all right, at this time, okay, when you're making your journal entry, all right, to record the depletion. All right, and here they're just waiting for the end of the year. They're going to record the depletion. Again, it could be at any point that they want over the course of the year. Here, the accountants have been told that 2 million tons, okay, has been mined this year. All right, so how are the people back in the accounting department, how are they going to record this particular event? All right. When you're depleting a mine or any type of natural resource, you're then always going to, for the amount that was depleted, the 2 million tons times the $8, that amount is now going to be charged to a current asset account or an inventory account. Okay. And then what is going to be credited? Again, these journal entries are different. What gets credited here? The accumulated depletion. Okay, this accumulated depletion, what type of an account is this? Whenever you see accumulated depletion or accumulated depreciation, what type of account is that? Who remembers? It reduces the book value of an asset. Excellent, Casey. It's a contra asset account. Okay, very good. All right, this accumulated depletion is a contra asset account. So where is it going to appear then? Okay, if it's a contra asset account, where is it going to appear on the balance sheet? With regard to the actual mine, the mine that we recorded here. Okay, this accumulated depletion is going to appear on the balance sheet under the assets directly below, okay, directly below this mine account, okay, the capitalized amount for the mine. So what, again, so here we mine 2 million tons times the $8 depletion rate. All right, that's the journal entry at year end. What does this look like on the balance sheet? On the balance sheet here, we're going to look, again, a natural resources as part of plant, property, and equipment. So here, plant, property, and equipment, mining property, remember the original cost, the $48 million, that's going to appear here, okay? And then less, because we prepared that journal entry at year end, the mining property less the accumulated depletion of $16 million, okay? That gives us then, what is the book value, okay, of this mine as of the end of the year, at the end of the first year? The book value is $32 million. Okay. All right. And where did this $16 million, what was the journal entry again? Because remember, this is the accumulated depletion is a contra asset account. Okay. So on an exam, if I asked you at the end of this asset's life, okay, this is a $1 million question. At the end of this, of the mine's useful life, okay, if all of my estimates were correct, what is going to be the ending book value of this mine at the end of its useful life? Anybody want to take a guess? If all my predictions were correct, what would be the ending book value? Excellent, Christian. Very good. The $8 million residual value. Excellent. Exactly. Okay, because I'm going to keep depleting it. If all my estimates are correct, I'm going to keep depleting it and depleting it over its useful life. Okay, and I'm going to use this journal entry for every ton that's mined. I am going to debit my inventory account and credit my accumulated depletion account. And I'm going to continue doing that until all of the 5 million tons have been extracted. Okay, and my best estimate, okay, at the time that the mine was purchased is that I'm going to be able to sell it to another party, okay, for $8 million for that residual value. Okay, so you can see here that when we're talking about natural resources, we're talking about significant amounts of money. Okay, now let's just do, for fun, let's just do this journal entry. All right, because, and again, this is something that you have to know. All right, so what if I told you, okay, what if after the first year, 1 million tons of the coal was sold for $10 per ton. Okay, what would be the journal entries? And I'll give you a hint. What would be the journal entries if during year one, 1,000,000 tons were sold for $10 per ton. Okay, we know, okay, and again, this is based on the perpetual inventory system. We know there have to be 2 journal entries. All right, so the first thing I would do, I would adjust my inventory account, right? Because my inventory account now is going to be reduced. All right, and what is going to be debited? I'm going to debit my cost of goods sold account. Okay, for how much? How much am I going to decrease? Am I going to debit my cost of goods sold for? All right, I sold 1,000,000 tons. 1,000,000 tons. Right, and I'm going to multiply that by what to get my cost of goods sold? Okay, by 8. Excellent, Stellan. By the $8. By the depletion rate. Very good, Lamai. Very good. All right, so I'm so the $1 million times the depletion rate, because that's the amount that I have to decrease my inventory account by. Okay, which equals 8 million. Which equals $8 million. Excellent. All right, so here I'm going to debit my cost of goods sold for $8 million. And then again, when I'm selling those goods, I know I can't report them as inventory anymore. So what am I going to do? I'm going to have to credit my inventory account for that $8 million. Okay, so that's the first part of the journal entry. Right? What else now do I have to do when I'm using the perpetual inventory system? Remember here, I sold it for $10 per ton. All right, so I'll give you a hint. We're going to debit the accounts receivable. Oops. And how much am I going to debit my accounts receivable for this transaction? I sold it for $10 per ton. Joshua? Anyone? How much am I going to debit my accounts receivable for? 10 million. Very good, Christian. Okay, so here, what I'm going to, because I'm selling 1,000,000 tons times $10. So how much am I anticipating I am going to receive from my customers? $10 million. And then what am I going to credit here? We know whenever we're doing the perpetual inventory system. Anyone? What gets credited here? Excellent, Daniel. Sales. Sales revenue or sales. Very good. Very good. So see how whenever you learned in your previous courses in accounting, see how it always comes back to haunt you? So sales revenue, again, for $10 million. All right, so that in a nutshell is how you account for a natural resource. Okay, and then how much would appear in my inventory account at year end? If this was the only transaction I had during the year, how much remains in my inventory account? I debited my inventory account for 16 million here. I'm reducing it by 8 million here. So what's the ending balance in my inventory account then at year end? 8 million. Excellent, Christian Joshua. Very good. Okay. So that's all the possible questions you could be asked on natural resources. Okay, in a nutshell. All right. What I want you just quickly as a little reminder, what I want you in life to remember is that when you have a plant, when you have a tangible long-term asset, and when you have a tangible long-term asset, that tangible long-term asset is going to be depreciated over its useful life. Okay. When you have an intangible asset, okay, when you have an intangible asset, you know you are going to amortize cost of that long-term asset over its useful or legal life, whichever is shorter. I'll just put useful life here. Okay, and then finally, when you are dealing with a natural resource issue. When you're dealing here with natural resources, you are going to then deplete a natural resource over its useful life. Okay, so those are the three different definitions. In effect, they do the same thing, right? They're taking the cost of a particular type of asset and amortizing it over its useful life. It's just that you have to know the specific terminology for each of them. Okay? And one thing I want you also to realize, because the next chapter, again, we're going to be dealing with the next chapter for the next midterm. The next chapter is a very tricky chapter. All right, it's going to be on the statement of cash flows, something that you've never really seen before. It's very different, okay? But if I asked you, do any of these type of expenses, either depreciation, amortization, or depletion, do any of those journal entries, okay, actually affect cash? Are they cash expenses? No. Excellent, guys. Excellent, Christian Stella. No. Okay, and that's something that we're going to deal with in the next chapter when we start dealing with the statement of cash flows. How you can have significant transactions like this for significant dollar values. Okay, they appear on the income statement, okay, as an expense. However, they do not involve cash flow at all. Okay, so that's just something to remember. Let's just start very quickly for 5 minutes going over the homework for this chapter. All right, we'll finish up with the homework. I'll give you a little bit of a heads up for the exam, okay, for next Tuesday. So just to reiterate, the exam, the midterm on next Tuesday is going to be on McGraw-Hill. It's going to be an hour and a half. Okay, I'll let you know the number of questions yet. I haven't decided yet because I did like a little bit of a policy change. The majority of the questions will be calculation questions, but there will be some theory questions, but I would focus on calculations. All right, and then let us go then to the, I could just start some of those exercises, just affirming what we've learned for this chapter. Okay, so you see really for Accounting 102, it's really different, okay? If you don't understand your basics, it's going to be difficult for you to follow through. Lysandra, I'm sorry, I see you have a question, or somebody has a question. What time does the exam open? Exactly 10:05. Okay, that's the time of the class. Good question. And I'm going to put all of this, I'll make it an announcement later on today. Okay. Oh, and also I'll post this homework. I'll post these exercises on Blackboard also, so you could review them, ahead of time as well. Okay, some of you have mentioned that helps you during the class. All right, so let's just start this at least. Coca-Cola. All right, Coca-Cola's distinctive trademark. Again, if you're in any country, in any world, and you see that red and white sign, Coca-Cola, it can be in any language, basically what that is. Okay, it is a trademark, and it's more valuable actually to the company than any of its bottling plants. Okay, so a trademark is more important than any of its bottling plants. But the company's bottling plants are listed on the balance sheet under plant, property, and equipment, but the trademark is not. Okay, how can that be? How can it be that it's a significant intangible asset, but it doesn't appear on the balance sheet? Is that possible? And the answer is yes. Okay, because most likely Coca-Cola developed that trademark internally. Okay, and basically as they were developing it in their marketing and their advertising department, they were basically just expensing any of the related costs to their income statement during those years. Okay, so here, since it was developed internally, it didn't have a significant cost. okay, that's going to be capitalized. So what happens there? It's not going to appear as an asset in the on the balance sheet. But as they're saying here, it's such a valuable intangible asset to them. Is it going to appear anywhere in the financial statements? Okay, again, not on the balance sheet because the cost wasn't significant, but it would definitely appear in the notes to the financial statements. Okay, because again, it is so important. And again, what goes in the notes to the financial statements? Anything that an investor or a creditor would be interested in knowing about that company. And of course, this is going to be very relevant. Okay. All right, just one more question then, and I'll let you go. Over what period of time should the various types of intangible assets be amortized against regular charges from revenue? Okay, and remember, when we're talking about intangible assets, with the exception of goodwill, okay, they are going to be amortized. The word is amortized for intangible assets. And they're amortized over the shorter of their useful life or their legal life. Okay, and which methodology do we use? We always use the straight line amortization method. Okay, there's no accelerated amortization method. Okay. All right, one more question because we have a few extra minutes, and then I'll let you go. The last one, again, these are pretty straightforward. After everything we did here in this chapter, let's just take an easy example here. So we'll do the next question, which is discussion question 15. All right, so the owner of Bennett Security, so several years ago, Bennett Security purchased a well-known trademark for padlocks and other security products for $150,000. Oops, I see I have a question here. Alexander, is that you? No, sorry, it takes a while. Straight line, very good, Joshua. Always straight line. Okay, so remember that. Very good. So several years ago, Bennett Security purchased a well-known trademark for padlocks and other security products for $150,000. After using, so they paid a significant cost, $150,000 appears as a capitalized asset, intangible asset on their balance sheet. So after using the trademark for 3 years, Bennett discontinued it altogether. They basically withdrew from operations of that business and then are now involved in a different industry. Okay, so amortization of the trademark had been at a rate of $7,500. So that was the amortization rate that they were using. Okay, and it was continued on the basis of a 20-year life. Okay, which the owner says is consistent with accounting standards. Okay, and what's happening is now they sold off. They're not involved in that business, in the lock business anymore, but they still have the asset as well as the amortization appearing on their balance sheet. And is that correct if they're no longer in that business? Okay, and the answer is no, because really this particular trademark is not really generating any revenue anymore to that. What would they do here? What's the answer? The owner of Bennett Security is in error. When the company discontinued use of the trademark, the unamortized cost should have been written off immediately. So it just would have basically any of the remaining value of that intangible asset should have been basically debited to some type of loss account or expense account. And again, that asset, that trademark should have been removed from books and records. Okay, and that's in the same line with any tangible asset. If you're not using it anymore in the business, okay, it doesn't have any useful life anymore. It would not continue to appear on the balance sheet or on the income statement. Any remaining value would be charged to expense in that particular year. Okay. All right. So what I'm going to do, I'm going to let you go now. And again, I'm going to go to McGraw-Hill and I'm going to remove the security, I'm going to open those files so you'll get to see what you have on your quiz. All right. Have a good day. Stay healthy. Wash your hands. We're going to continue with brief exercise 9-6. Okay. Do a little bit of review for the midterm and then continue from there. Okay, you're welcome. Have a good day. All right. And everybody stay healthy. All right. Have a good day. Thank you. Thank you for your input all the time. I appreciate you guys.